Our next session will be an outlook when it comes to debt financing. And I'm very pleased to welcome to the stage Travis Mora, Co-Head of Energy and Natural Resources at SMBC. Welcome, Travis.
Thank you very much. So good afternoon, everyone. My name is Travis Mora from SMBC. So I'm going to talk to you this afternoon about debt financing for upstream oil and gas. And I guess my key lesson learned from this morning is that I should change it, perhaps the title next time, to Upstream Oil and Gas for the Belt and Road, as it seems to be the topic of conversation at the moment. So before I start, this is a disclaimer slide my company makes me show, which basically says you can't trust anything I tell you this afternoon. So this is my agenda for today. First, I'm going to give you a very brief introduction to SMBC. I'll look at some typical debt finance structures we see for oil and gas projects. And finally, I'm going to look at a finance market update. So SMBC, we're a Japanese bank, very big in project finance. Globally, we've got roughly 380 people just looking at project finance or non-recourse lending across all the sectors. Some of the awards that we've won, so we're awarded Global Bank of the Year 4 times over the last 10 years. I think only bank to be awarded that. So we do not only lending, we also do advisory. So this just shows some of our advisory projects we've done globally. I mean, we do stuff across all the oil and gas value chain, from upstream, offshore, downstream, petrochemicals, LNG. And in Asia Pac, this lists some of our experience. So you can see most of the countries we've got covered. I think most active locations, perhaps probably Indonesia, Malaysia, Vietnam, but these days Bangladesh, Myanmar are also quite active. And this just shows some of the projects we've worked on. So on the left-hand side, there's a large a gas field project. We're a financial advisor for TCF. The project in the middle is an upstream project in Indonesia, a Sonoro project field. And the one on the right-hand side is Ichthys LNG, which is the largest project financing ever. I think around 20 to 25 billion debt raised. So just move on then and look at some typical debt structures we see for oil and gas projects. So I'm never quite sure where to pitch these presentations. So just for those who are not familiar with the general structure or the difference between corporate finance and project finance. So the structure on the left is a typical corporate finance structure, whereby lenders lend cash to the sponsors for a project on the basis of the strength of the sponsor's balance sheet. And then the sponsors on-lend the money into a project in a form of equity, or it could be debt. That's contrasted to the project finance structure on the right-hand side, where you'll see lenders lending the money directly into the project. Sponsors still put money into the project in the form of equity, but it's reduced to maybe 30%. So the difference for lenders is on the right-hand side, project finance, the lender's source of repayment is the project itself, whereas on the left-hand side, the lenders are looking to the sponsor's balance sheet for repayment. So this is a lot of benefits, of course, for sponsors because they reduce their risk. They only need to put in 30% of the equity. Plus also, they may not have the balance sheet to be able to raise the full debt for the project. So typically, the type of structure we see for financing oil and gas projects in Asia Pac is some variation around a project finance. So this slide just shows the financing life cycle for a typical oil and gas project. You can see appraisal, exploration stage. Typically, these stages are financed through some form of equity or corporate finance. We move into late stage exploration, typically maybe possible to get mezzanine debt. And then when it moves into development stage and production, that's when you can access senior debt in the form of prepayment, RBL, or project finance. So this slide just shows 4 of the typical structures we see in the debt finance market here in Asia Pac. I guess it's not a complete list of all the types of finance, but this is the typical ones we see. So the first one on the list is mezzanine finance. So this is typically, and I've just plotted these against, you can see size of company or size of project and financing tenor. So first off is mezzanine finance. So this is a type of finance which you don't typically set out to arrange, but it's something that you might need to plug a gap. So typically this is arranged by smaller companies and can be anywhere between 2 to 5 years. So next you move up the scale to prepayment finance. So again, company may not have strong enough balance sheet to arrange corporate finance on their own balance sheet, but what they can do is arrange finance through the offtake contract. So typically this financing around 1 to 3 years. Then when you move up the scale to the independents or a mid-sized project, you're looking for a longer tenor financing, 3 to 7 years. Typically they look at a reserve-based lending. And finally, you've got a very large sponsor or a large project. You need a long tenor financing if we look at a project finance approach. So just looking at each of these individually. So what is mezzanine finance? So mezzanine finance is debt which is subordinated to senior debt, but it's senior to equity. So it fits somewhere in the middle. So in terms of mezz debt, we don't do much at SMBC in oil and gas projects here in Asia Pac. But what we are, we're an investor in a fund, Pierfront Capital, along with Temasek from Singapore government. And what we typically do is if a project needs mezz finance, then we'll typically work with Pierfront to arrange that. So some of the features of mezzanine finance. So typically it's a very flexible instrument. It can be customized in a number of different ways. Tenor around 2 to 5 years, but normally there's some kind of defined exit strategy. Pricing, well, it's more expensive than senior debt, but usually cheaper than equity. And investment size typically around 30 to 40 million. I mean, if you need more mezzanine debt than that, then typically you can arrange with other funds or investors. So next one on the list is prepayment finance. So prepayment finance is essentially advance purchase of goods sold. So it's a type of finance where if companies don't have a strong enough balance sheet to arrange corporate finance, then what they can do is organize finance through the offtake contract. And this has a lot of benefits for smaller companies because it gives them access to banks that they wouldn't previously have access to. Also, this type of finance is quite flexible in that it can be structured as a corporate or a commercial agreement, so it doesn't necessarily show up on a company's balance sheet as a debt. So this has benefits. Company may be close to debt to equity covenants, then what they can do is arrange a prepayment finance if they need extra cash. So this is the typical structure for a prepayment finance. So here we see an oil producer typically enters into a sale and purchase agreement with a producer or a trader who agrees to buy forward the next year, say, of production for the company at maybe $30 a barrel. And what the trader does is not typically goes to a lender, a bank, who gives them the money for that, and then they on-lend it to the producer. Then once the producer starts producing, over that year, the physical flow goes to an off-taker, the funds then flow to the lender, who uses the first $30 to repay the loan, and then the rest of the cash goes to the supplier. So this is a type of financing that's very easy to put in place, very quick, and is often seen for smaller companies. So as we move up the ladder, next one is reserve-based lending. So reserve-based lending is typically a type of lending where it's based on the reserves. So this could be 1p or 2p reserves, depending on the quality of the reserves in the field itself. It's a very flexible type of finance. You can structure the repayment profile in many different ways. And it's also flexible, and you can structure it as a wrapper, so you can add and remove fields from the financing if you want. So this diagram just shows the way that we typically size a reserve-based lending. So it just shows a production profile. Then banks will typically want a 25% reserve tail at the end, so just some buffer in case something goes wrong. And then what we'll do is we'll work out production profile, and then using some price deck of the forward price for oil, we'll work out how much debt the project can sustain over the life and over the project life. So this type of financing usually involves some type of redetermination mechanism. So every 6 months you'll check the oil price and check the reserves and see if the financing goes up or it goes down. So this shows a financing structure for a reserve-based lending project. And see, this is for a project itself. So sponsors will usually set up a borrower SPV, which will enter into the reserve-based loan agreement with the bank. And this SPV will own the field asset itself. And they'll typically have offtake contracts with oil buyers. So once they produce the oil, sell the oil, then the revenues come to a proceeds account, which is controlled by the banks. First tranche of cash is used to go to the borrower to pay for operating costs and taxes. Next one goes to lender to repay the debt. And finally, any dividends then go to the distribution account for the sponsors. So this is a usual type of structure that we've seen for many projects here in Asia. So the final type of project is a project finance. So this is for your large projects. And project finance is simply a financing of an asset based on the cash flows of the asset. So key features, usually it involves some very project-specific asset, which has a very strong cash flow associated. And because well-structured projects usually can attract a lot of banks, usually the financing cost for this will be much cheaper than doing a reserve-based lending. So these are the type of finance you typically see for large petrochemical plants, LNG plants, Fpsos, FSRUs, that type of large capex infrastructure. So this just shows a financing structure for an Fpso project. So you have an oil and gas company who's got an offshore field, needs an Fpso to monetize the field. So what they do is typically enter into an Fpso charter or a lease contract for an Fpso. An Fpso company. That company will set up a special purpose vehicle for the project itself. They'll also enter into a loan agreement with the lenders on a PF basis. So lenders will give them the money. They'll use that money to construct the asset, which will be owned by the special purpose vehicle. Lenders will, of course, take security over the asset. And then through the operations stage, lease payments under the charter contract will be then used to repay the project finance loan. Skip that. So for both reserve-based lending and project finance lending, a very important aspect is lenders' due diligence. That's because we're just relying on the asset itself or project itself for repayment. So one of the key areas of due diligence is reserves. So we have an in-house engineer who will look at the reserves for a project and make sure there's nothing that we're not aware of. Usually we'll get a technical engineer who will assess the project if there's any construction or development risk involved. Legal, of course, very important. Insurance is quite crucial for a project finance because our only source of repayment is the asset itself. So if something happens to the asset, if there's a total loss, we need to make sure that there's insurance coverage to repay the loan. And finally, model and tax. So some of these project finance models can be up to 20 or 30 sheets of calculations. So it's important for these large projects to make sure someone audits the model and make sure there's no mistakes inside. Okay, so just moving on to the third part, which is a oil and gas finance market update. So I guess three drivers for oil and gas finance market. First one being policy, second one being oil price, and third one being macro factors. So in terms of policy, we haven't seen that much impact in terms of oil and gas financing in the market here in Asia Pac. I know we've seen some banks in other regions, particularly in the US and shale gas, banks pulling out of that market. But here in Asia Pac, I mean, there's been a few examples. I think IFC said they're no longer doing upstream oil and gas financing, but there hasn't been a big impact so far on the oil and gas financing market. In terms of oil price, it's had a bigger impact. When we saw the oil price downturn a few years ago, definitely there was a big reduction in banks in the market looking to do deals in oil and gas, and I think maybe oil and gas increasing at the moment, so oil price increasing, so perhaps banks are starting to get back into the market. And finally, macro factors. So macro factors, I think maybe the biggest factor is interest rates, so I'll just spend a couple of minutes on that. So this chart just shows LIBOR. Oh, here it is. Okay, so the green line is a 5-year IRS, so it's essentially a fixed rate for 5-year money. The grey line is a 6-month LIBOR, and the red line is 3-month LIBOR, and then we have the Fed funds rate. So I guess the key point on this chart is we look back 6 months ago, 6-month LIBOR was around 1.5%. And it's been between around 1 for the last 10 years. It hasn't been higher than that. So over the last 6 months, we've seen LIBOR go from 1.5% all the way up to 2.5%. So it's a 100 basis point increase in 6 months. So it's been quite astonishing how fast the cost of funds has actually gone up. So this is going to have quite a large impact on the viability of some projects because the funding cost going up at such a steep rate. So this chart is, just an interesting chart showing the flattening yield curve. So here we look back in second half 2017, we had 2-year IRS and 10-year IRS. So we say 2-year money around 1.6%, 10-year money around 2.2%, which makes sense in an increasing rate environment. You expect cost in the future to be more expensive. But I think what's interesting is you look where it is, the market is today, so you can see the spread between the two decreasing substantially. So now we have a 10-year money at 2.9% and 2-year money at 2.7%. So the spread between the two is actually very, very tight now. So what's this saying? I mean, this is essentially saying that people think that the economic story in the US has gone on for 10 years now, 10 years of growth. So people predicting that perhaps in the next few years the economic growth story is not going to continue in the US. And perhaps we'll start to see a downward cycle in interest rates. So yeah, it's very unusual to see such a flat or small difference between the two rates, particularly in a raising rate environment. So if you're a betting person, maybe it's a good time to put a bet on 10-year money and maybe cheap. So finally, oil price. So this chart just at the top shows Brent. So you can see Brent heading up, as we all know. This shows the crude stock. So that kind of makes sense, but I think as we heard yesterday, I think Ian pointed out, I mean, it's very hard to relate fundamentals to oil price, but this kind of looks about right. Stocks are going down, prices going up. So this shows the forward curve for Brent. So what we can see is in backwardation, which is what we'd normally expect for a healthy market. But I think the interesting thing to note is that the extent of the backwardation on the forward curve is probably the greatest it's been for 20 years. So what does that mean? I don't know, but perhaps people are suspecting that the $75 oil price may not stay around forever. So thank you very much. Happy day.
Any questions from the floor? Oh, hello.
Yeah.
Peter Kwong, Alpha Group. What you were talking about the P1 loan against P1 or P2 reserves. Now, obviously, if you're a bank, you would look at like a company such as, oil and gas, like Gulf Canada Resources or whatever. Rather than lending against the P1 or P2 reserve, you would, as a bank, if you're a bank, you would rather lend against the company, the petroleum company, whether it be Exxon or Shell or whatever.
Yeah.
So how would that realistically, in the real world cases, if you're a bank, you would lend against, if a company such as Gulf come to a bank to ask for a loan, the company, the bank will look at the company rather than P1. Do you know what I'm asking?
Yeah, no, I understand the question. So I think the way to answer this is if you're ExxonMobil or you're Shell or you're BP, if you're ExxonMobil, Shell or BP, you wouldn't do this type of finance. You would raise money on your own balance sheet because your balance sheet is huge and banks don't have a problem lending to your balance sheet. But if you're
even for a small company.
So if you're a smaller company and you don't have that huge balance sheet, and banks are not going to give you any value if you lend on the balance sheet. So what you do have is perhaps you have a lot of reserves. So this is how typically the independents raise their financing. So they can't raise on the corporate finance approach. So what they'll do is they'll raise as a corporate finance, they'll raise a quasi RBL. So this will be, banks will be willing to lend money because the value of the company is in the reserves. So they raise money on that, and that's typically what we see for most of the independents. But this approach can also be applied for projects. So if the project has a good reserve, then banks are willing to lend on that reserve because we understand it's going to be produced in the future. And as long as we're able to take the performance risk of the field, which I guess is the key risk that we're taking, then we're willing to lend money to the project.
So basically, you're looking at a junior company, was not much of ongoing production of other fields. So that okay, I see. Okay, got it.
So if you're a very junior, then I guess first if you're having trouble raising on an RBL, because some banks may not be willing to give you an RBL, so then you would look at a prepayment style financing, the first style of financing, which is a more shorter tenor, but you can use the off-taker or the trader to help you get the cash, because you use their balance sheet or their name or their reputation to credit enhance the deal, as it were. Yep.
As you work for a leading Japanese bank, I mean, we see China strategically securing resources of all kinds all over the world. And Japan, since Fukushima, runs maybe 99% on fossil fuels, the second largest economy in the world. So two things. Your bank, how far out do you see Japanese energy users trying to hedge themselves? And second, how do you see Japan, the government and its various government-linked entities trying to secure natural resources, because China is doing the same, and obviously there's going to be like a fight for resources in the at least medium, if not long-term future.
Yeah, I think historically we've seen a very big push from the Japanese government or Japanese institutions to secure supply. And you look at a lot of especially on the LNG side, so you look at all the big projects, and normally they've got some form of Japanese involvement, acting as a sponsor or an off-taker. So historically, I think Japanese have been willing to pay a premium for security of supply. As we move forward, I mean, there's more and more LNG in the market. Perhaps that premium is reducing. Maybe some of these Japanese companies looking to become aggregators. So perhaps we're seeing that trend that we saw previously is starting to lessen as it's moving forward. If that makes sense. Yeah.
Thank you. Any more? Okay, well, thank you very much, Travis.